Right, welcome again to cost accounting. Right, so our session today is going to be with reference again to the notes that were sent in the group, and then a couple of extras from there, of which I'm going to send the notes for those extras probably tomorrow or the day after. Just a bit of an extension of those definitions and some applications to those definitions. So those notes are important to the extent to which you are able to apply those notes in a given scenario, those definitions in particular. If you are able to apply them in a given scenario, that's just how important those ones are. But picking it up from there, we're talking about a distinction between direct costs and indirect costs. Okay, I think I'm just going to share something here for the sake of visuals. I know it's a little bit difficult to concentrate when you're not looking at something, but someone sent me, Ayanda sent me some questions this afternoon, right? So I think I'm going to use part of what she sent there to point out something, right? To make a point. Right? So it was from the all right, I think I'm just going to put it here. Very good. It was from the textbook. I think you guys can see from example 5.1. I'm not sure now which textbook this is, but she said it's from the textbook. I'll ask you which textbook is after class. All right. So looking at what's there on example 5.1, and by the way, part of the questions that we are going to be getting are going to be in this format, right? They're going to be in this format. So I just want to break down the things that we see here. So some of these things we have covered, say, at second level. Some of the things are covered at second level, and I will make mention of those things there. Actually, most of those things there, and then I will talk about what's going to be relevant here for us. Okay, so what you can see in management accounting, it's very important when you get a question or when you have a scenario to first try and identify whether you are dealing with actual information or you are dealing with budgeted information, right? And how do you do that? The first thing to do is obviously to go and check on the question, on the requirement, whether they require you to deal with budgeted information or they require you to deal with actual information. So most of the questions that we get now at this level, you will get mixed information, right? They normally give you mixed information because somewhere in the questions, they might ask you to do some variance analysis, and of which that's going to entail you making use of actual information and budgeted information. So the first thing that you need to establish in a question is, are you dealing with actual information or budgeted information? So that as you search for the information, you know to only identify what's important, to make use of what's important and to ignore the rest temporarily. All right. So in this instance here, so our main focus, by the way, is going to be on the costs there, on the costs right down there. But again, I'll just talk about everything that you find on that statement there. All right, so we are given the actual sales. Let me blow it up a little bit. We are given the actual sales there, right? We're given the actual sales there, 980,000 at 40 cents per mint. So we're dealing with mints here. So establish again, after establishing the actual and the budgeted information, which one is relevant for the particular question. Check again the measurement units, right? What you are dealing with in terms of units. Maybe it's liters, maybe it's boxes, whatever it is that you're dealing with. Just try and establish that. So in this case, we can already see that when they talk about means, the units that we're dealing with there are means, right? They are units of means. So it means when we talk about sales, so the quickest way to find out what the units are, just look at how they sell the particular product, right? So if it's going to be sold per, you do get some questions where maybe you are dealing with something that's a liquid, right? So liquids are measured in liters. But when we talk of selling that particular liquid, sometimes it will have to be packaged, let's say, in bottles of 500 milliliters, like Coca-Cola, for example. Sometimes it's 300 millimeters, it could be 500 mils, like that. So that 500 mils is going to make a unit. So when we talk of units, think of that 500 mils, right? Think of it having been bottled up into 500 mils. All right. So in this instance, there we go, we have means. So these means are the units that we're going to be dealing with. So take note now that in some instances, you're going to get, like if you look at the materials there, you're going to get kgs. So try by all means not to confuse the units and the kgs. Sometimes it's going to be liters. You will realize that some of the material that you use is going to be measured in liters or milliliters. Some of the material is probably in meters. Some of the material is in kgs. But at the end of the day, you want to combine all of that so that it becomes one unit, right? One unit of means or one unit of whatever. Once it has been packaged, combined, manufactured, then it's going to be a unit of something. So just try and establish that in every question that, okay, what units am I dealing with? This is a unit of what? If you are dealing with liters, then those liters to make a unit, how much of those liters do you need? All right. So the good thing with this one is means are already means, right? Most of the products that we might be dealing with here are physical products, right? So they are most likely going to be packaged, right? But we could get, I think on the study guide, you also do get questions that deal with liters. I can't remember now if it's a past exam question or it's in the study guide, but I think you should get that in the study guide, right? Where sometimes you have 3 different types of products that are being packaged into different sizes, 300 mils, the other one is 500 mils, and then the other one is a liter. Something that you would have in practice, right? Something that you can expect with a beverages company. So when that happens, establish again the units of the first product, the units of the second product, and of the third product. All right, let's look at the costs. Okay, so in this instance, it seems like we are dealing with actual material, because I see, sorry, actual sales, actual production, actual information. That's what it seems from what I'm reading here. All right, so the actual sales are given there as 980,000 at that price each. So the other thing that you should also establish in a question is how many products are you dealing with? That's the other thing that you should check. How many products are you going to be dealing with? So you need to check that one out there. All right, so the actual means that were produced in 2010, as it were, is 980,000 means there. And then the production costs are going to be consisting of direct materials, direct labor, variable manufacturing overheads, budgeted fixed, and then the normal capacity there is 900,000. So it seems we exceeded the normal capacity. Normal capacity is normally 980,000, but there they went right up to 980,000. Right, that's quite good. So on the notes, we spoke about direct costs and indirect costs, right? And we said direct costs are the costs that can easily or physically be assigned to a product, right? They are the costs that you can physically assign to a product with relative ease. All right, so most of these direct costs are going to be having the word direct, right, as a starting word there. Like you see, direct materials and direct labor. Those are the direct costs there. All right, so all direct costs are variable costs anyway, because they're gonna be varying with the quantity of your production. But let's just not confuse the two there. I'll get to that later. So the direct materials there that's given, it's 980 kgs at 20 rand per kg. All right, so in reading out this information, because we will be getting quite a lot of questions like this, like these, in reading out this information now, you need to establish that 980 kgs per 20 kgs, seemingly it's the amount of kgs and the price per kg that was used to manufacture the 980,000 means. So this was during that period. So in other words, this is giving us the information 980 so 980 kgs at 20 rand per kg is basically giving us the cost per kg that we actually applied in the manufacturing of that 980,000 units there. All right, so which is pretty straightforward there, right? So you just need to be on the lookout there. You just need to be on the lookout there. Like I mentioned earlier, that in this instance, we are dealing with 980 kgs at 20 rand per kg. So this is not like, this is different from saying 1 unit, or in other words, the cost to manufacture 1 unit in terms of direct material was 20 rand. That's not what that one means there. So if you want to find the cost, therefore, per unit, then you need to find the total cost. I think how I normally simplify it for myself, because some of these questions can really become complicated. You find that there's 0 point something, sometimes it's 0.75 millimeters of this at what price. So the best thing to do, if you want to simplify it, right, if you want to simplify this here, is to first find the cost, the total cost to manufacture the number of means in this instance, or the number of units, the total number of units, right? So they already told us that to manufacture this, to manufacture 980,000 means they used 980 kgs. So which means 980 kgs times 20 will give you the total cost. The 980 times 20 will give you the total cost to manufacture what? 980,000 means. So that's 980 there for the kgs, and the 980,000 for means. They don't necessarily have to be similar, those numbers. They can basically take any number, but the method is just the same. So 980,000 times 20, sometimes it could be 0.5 kgs, right? Whatever the case is. But like I'm saying, situations are also not always the same, right? We always need to go with what's given in the scenario. So, but the bottom line is the method is just the same, 980 times 20. And then if you divide that total there by 980,000 means, that's going to give you the price, or in other words, the cost of direct materials per mint or per unit, right? You will get that. But again, it depends with what the question wants. Sometimes the question requires that you have the calculation per unit. Sometimes you need it in totals. So you just need to be versatile there to be able to move from one end to another. Yeah. Same with direct labor. So how you treat direct materials is just the same way that you treat direct labor. So sometimes this information, like 980 hours at 50 rand per hour, you will typically find it in your additional information. They will tell you that let's say the actual production, okay, like they used 980 hours for the actual production, and maybe the rate was given as 50 rand per hour. So they could give you in words like that, or they could just put it down in a table format the way they did it here. So the method is the same. What we did on top also to at the bottom, it will be 980 times 50. So that one will give us the total cost of those 980,000 means. So if you want to get per unit, then you divide by 980,000 there. But this again usually gets clearer the more we tackle more questions that have got things that are similar to this here. Right. So we have two direct costs there, direct materials and direct labor. Those two there. Then on the other side, on the notes, I spoke about indirect costs again. So indirect costs are overheads, right? The other term that is given for indirect costs there is the overheads. But now, how do we treat overheads? Right, overheads can either be variable or fixed overheads, right? So the indirect costs can also be separated based on whether they are variable or not variable, right? In other words, they are fixed if they are not variable, so you can separate them. So most of these questions that we get here, they are going to be separated in those terms, especially when we're dealing with financial statements like this, variable and the ones that are fixed. So the variable manufacturing overheads. So any of these variable costs, what you need to establish in terms of variable costs is what are they varying with, right? What are they varying with? So the thing is, by definition, variable costs change, right, with a level of activity. They change with a level of activity, or they vary proportionate with a level of activity. So in this case here, when we're dealing with costs, we expect that costs shall increase, or costs are always going to be increasing as you increase the level of activity. So these, we are looking at those in terms of total. So if you look at on the notes, if you look at the notes there are two diagrams that I put up. So there is the variable cost in total, where it shows a graph that is positively sloped, a graph that is increasing, that has an increasing slope going up. And then there is one that is constant. So we say the one that is constant is the cost per unit. So the cost per unit doesn't change, but in total now, the variable costs are going to be changed. So variable manufacturing overheads there. So we expect that these manufacturing overheads are the type that vary with a certain level of activity. So now you need to establish what level of activity is that. So is it units? Is it machine hours? So usually if it's going to be varying with machine hours, sometimes it could be with labor hours, sometimes with units. It obviously follows that if it varies with labor hours, it's going to vary with units in the same direction, right? Why is that the case? Because we know that the more labor you put into a product, the more units you are expected to manufacture. So which means if your costs are varying in accordance with your labor, then indirectly they're going to be varying also in terms of your units, right? But in terms of calculation now, you need not to confuse that. You need to stick with the information that's given, right? You need to stick with the information that's given. So in this instance, we are told that it varies per machine hour, right? Per machine hour. And then that information there, 1,960 machine hours were used to manufacture 980,000 units. And then the cost of those overheads is estimated to be at 30 Rand each. So to get the total cost, therefore, it's just easy. 1,960 times 30, that will give you the total cost. Then if you want to get the cost now per unit, then the cost per unit, you just divide the total that you got there by the number of units right there. That's going to give you the total. But now that we are talking about variable costs and fixed costs, right? So it's easy for examination purposes because we are most likely going to be told that your variable costs are such and such an amount, your fixed costs are such and such an amount. But there are also some instances, the one particularly that I promised to bring last week, where they bring about mixed costs, right? They bring about mixed costs. So from last year, I think there was one where there were step costs that were put up there. There were step costs that we put up there. But I think the easiest example that I can come up with is on the mixed costs. because that one we have it from the last exam, I think. All right, so why is it important for starters for us to be able to distinguish between direct, indirect costs, variable, and fixed costs? So you must remember now that the reason why you are doing costing, you are doing management accounting, is for decision-making purposes, right? It's for decision-making purposes. So most of these statements that you are going to be preparing here, you are preparing these statements for internal use, for management use, to assist them in making decisions. And in order for them to make prudent decisions, it's important for them to be, for you to be able to draw these distinctions here. Because this is costing, for example, if you check on the notes, we're talking about a distinction again between product costs and period costs. And on the notes, it says product costs are the ones that are assigned to the product, right? To say their inventory, the stock, whatever it is that you are manufacturing. And then period costs are the ones that are expensed. These are the ones that have got nothing to do with the product directly, with manufacturing the product. So these costs will be costs like, say, your marketing costs, right? So if you're going to be making, say, decisions pertaining to a product, you want to know how expensive that product is to manufacture, right? How expensive is it? Now, there's an issue of load shedding, right? You decide that, should you buy a generator, right, and use diesel or petrol, or should you go the solar route, right? Because you're a smart person and you've done management accounting, what's the first thing to do is to cost, right? To cost the items, to draw up the costs. So in drawing up the costs now, you need to know what are the direct costs, what are the indirect costs, what are the relevant costs actually. You need to know the relevant costs for each and every one of these decisions so that you can be able to make a sound decision, a well-advised decision, a calculated decision, right? You don't just say, I think I read an article not so long ago, how they were saying South Africa wants to move to green energy, right? I think you are aware of that now. I believe we are in a transition towards green energy, because it's supposed to be cheap, right, and good for the environment. But I think Denmark is already using green energy. I believe it's Denmark, but they have one of the most expensive tariffs. The tariffs are high. The electricity tariffs are quite high there. So the author of the article was actually saying, okay, how is solar cheap, or wind? Sometimes they use those windmills, right, to make electricity. How is that cheap if it's actually expensive in Denmark? How is it going to be cheap for us here? You see. So you realize that sometimes in making decisions, we don't just go with what we like and what we feel like is good. You see, we need to do the calculations and ensure that we are actually saving. Are we gonna? Is this really gonna be benefiting the society, right? And just to give you a tip, I'm sure Eskom is looking for a CEO, so just drop in your CV there. We're hoping that we might use some of this information to benefit the country. You need to go there and do costing, right? Go there and do calculations and ensure that the world is benefiting from your education. All right. So the bottom line is, costing is important now. You need to assign the right costs, because any decision that you make now can either cost the organization, in the sense that you can find yourself producing something that is expensive unnecessarily. And then again, that cost is going to be passed to who? To your consumers, right? It's going to be passed to your customers, the people that you're going to be selling that product to. You obviously don't want to make a product and then you sell it cheaper than its cost to you. You want to put a markup, right? And in putting a markup, first arrange those costs and then you see what percentage you can put over those costs. So if you're going to be doing, say, for electricity, first find out the cost of generating that electricity using, say, sometimes you can use water, right? Like those hydroelectric power stations. Sometimes you can use solar. Solar is very expensive to install, by the way, so it's not also that cheap. maybe those windmills. Find out that cost and then break those costs down and then decide now or present the information to the relevant people so that they can decide the correct pricing of that electricity. So most of that anyway, most of that you are going to be doing on the sister module, financial management, there, when you're going to be assessing that project, how good that project is anyway. So this is the starting point of that, the costing of that project, so that we know that this project is going to cost us such and such an amount. So because costing is important now, you need to know how to separate between those costs. In other words, you should identify those costs so that you know which of those costs are relevant. For example, some of those fixed costs are not relevant. Some of them are sunk costs, you see. Those are costs that you have incurred in the past, and they are irrelevant to the decision that you are trying to make today. So don't just add up all those costs there and take those costs to the minister. You see, you will fight with the minister. That is if he understands what you are doing there. All right, so now there's an important distinction, variable and fixed costs. I said sometimes these costs, particularly in practice, if you look at electricity and water, there's a fixed element and a variable element there, right? So under those circumstances, how then do you separate between the fixed element and the variable element? Because some of these decisions that we are arriving at, some of these statements that we are drawing will need us to distinguish between, the variable and the fixed cost. So how do you go about that? There are methods there that I'm gonna list down on the notes, but I think it's 3 of them. If I can, let me see if I can suck them off my thumb. But one is the scatter plot, and then the other one is regression analysis, and then the other one is the high and low method. Yeah, the high and low method. So those are the methods that you will use now to separate between those costs there. So you realize now later, because this information, we don't just use it when we are drafting statements, right? You will use it when we are drafting certain statements, as you will see. But sometimes there are also certain decisions that we need to arrive at in future, where perhaps they will need us to compile the variable costs together to pull them up together. Sometimes I think if you did this at second level, you still remember when you were doing break-even analysis, where you need to have your fixed costs totaled up together, and then you also have your contribution per unit. So to arrive at those there, if you have costs that are mixed, then you need to separate between the fixed and the variable costs, right? And I'm sure by now you should know the importance of break-even analysis, but we are going to do it anyway. We are going to do so. This is where some of this information comes in, your knowledge of information. So they will not ask you to define mixed costs, right? But they will give you a mixed cost, and then they expect you to apply that information, say, to get contribution per unit for a particular product. You see, so if you are going to be doing this in practice, that's pretty much what we are going to be doing there. So most of what we use anyway is going to be the high and low method, but we will also talk about the regression analysis. I don't think you will get scatter diagrams here. We don't do much drawing in management accounting. So you need to be careful of that there. So you can distinguish between those two types of costs using any of those 3 methods there. But other than that, now still on the indirect costs there. So the indirect costs, like we said, those costs are they are the costs that cannot be assigned easily or directly to a product. So those are the overheads. But at the end of the day, if you're going to be compiling costs that have got to do with the product, sometimes you will need to assign those costs to a product, right? But it's not easy. I think I underlined again on the notes there. The word that they use is I think I underlined surrogate. Yeah, I underlined surrogate. But the other word, which I think I didn't put there, which I think we should have put in, is now the English word has left me. Where we need to come up with fine, we do need to come up with a surrogate method to assign those costs here, but it's arbitrary, right? And arbitrary. So that's the keyword that you normally get when you're dealing with overhead, how you assign overheads to different products. So let's say you are in one factory, right? And then that factory manufactures, say, different products, right? Different products. And then there are certain costs that are direct, right? That can be directly linked with different products. And then there are certain costs now that are shared. Say you are using the same lighting, you are renting the same building to manufacture different products. How then do you assign those costs? If you wanna say, if you wanna calculate the cost of say product A, when you also have product B and C that are also sharing the same factory space and that are also renting the same building there. So how do you assign those costs? So we therefore use surrogate methods there. So those surrogate methods, you are basically gonna be looking for, say, the biggest influence there on the product or on the expense rather. For example, if you're gonna be dealing with say your factory space, right? Your factory space, you might want to apportion that cost based on the space that is occupied, right? In terms of, let's say, if your rental is going to be 100,000, then the product that occupies the biggest space in the factory, you can therefore assign a bigger portion of that rental to the costing of that product. Right. So what we are later going to be doing is in relation to absorption costing, which is also second level stuff, absorption costing and marginal or direct costing, right? Direct costing. So this is going to be important in that respect again, in that respect, because when we talk about product costs are the cost to manufacture a product, right? Costs that can be assigned to a product, we call them product costs. So remember, we said it's product costs or period costs. Period costs are expenses that have got nothing that is directly linked with the product. Like we said, expenses like marketing, right? So they do not really build the product, right? They are not part of the cost to build the product. So we treat them as period costs. But with product costs now under absorption costing is also called full costing, right? We normally use all the costs, which is the variable costs and the fixed costs there in terms of which are the manufacturing costs, by the way, variable manufacturing costs and the fixed variable cost to come up with the total cost of that product. But again, like I'm saying, if you're going to be dealing with multiple products, now you need to be able to separate between those products. So which means part of those notes, you're going to be getting how to separate those fixed overheads or how to apportion those fixed overheads to the different products there. So it's two methods that you're going to see there, the traditional method and the ABC. So that's also a favorite of the examiners. So we are going to do that there, right? So when you are using those methods now, you are basically taking a huge cost like, say, factory rental, and then you're saying part of that factory rental should be apportioned to product A, part of it to product B, and then the other one to product C, right? Because they are not directly linked, it's not a direct cost. You can't come up with an accurate method to do that, hence you come up with intelligent assumptions there. But for exam purposes there, and for the sake of this module, we are going to be given what assumptions to go about when doing that there. All right, so I think for starters, what we'll be having when we're doing income statements, we are going to be dealing with the simple method, the traditional method, where you'll be doing OAR, the overhead absorption rate. Like in this instance, in this question, it's just the overhead absorption rate there. Right, so nothing complicated. And then later, maybe we might have a situation where we need to apply the activity-based method on that. But you really see how easy these things are much later, right? There's really nothing complicated to complicated with these things. All right, so the other thing now that's important with these questions, right? Other than, of course, identifying your direct costs, your variable manufacturing overheads, you also need to assess your fixed manufacturing overhead. So I actually forgot to mention that the starting point is to check whether you are using absorption or direct costing, because that's going to be important, especially when it comes to your valuing of the closing inventory there. So one method is going to include your fixed manufacturing overheads. Again, remember, when we are talking of product costs, we are talking about manufacturing costs, right? We are talking about manufacturing costs. So don't talk about don't talk about fixed administration costs as far as product costs are concerned. Just deal with the manufacturing cost, the cost to manufacture there, right? So you're going to be dealing with the manufacturing costs, the fixed manufacturing costs. So those ones need to be included there again. So hopefully on our next session, if I can incorporate it on the notes, I want us to put in the issue of an over absorption and then under over absorption or over recovery, under absorption and under recovery, to see under what circumstances those issues come in relation to budgeted and actual information. And then from there, I think we can be in a situation, in a position to tackle a question, and see what we can apply on that question, right? I don't know if we have any questions so far with regards to these costing terms and these simple things here. Do we have any question?